How in the world are mortgage interest rates going up when the Fed has reduced interest rates twice within the last 2 quarters? Well, that's what I'm gonna be talking about in today's video. The 3 reasons why mortgage rates are up, even though the Fed's funds rate are down. This is Steve Peterson. Welcome to our channel where we talk all things commercial and investment real estate. And basically right now, me and a lot of other people in the business are like, wait a minute, we thought in September's rate was coming down. We knew rate cuts were coming. And we're thinking, hey, the gravy train is coming back, or at least some sort of relief from the pain we done had the last 2 years is coming. Now, what has interestingly happened since, September, particularly in October and November, is that while we did have 2 Fed rate cuts, mortgage rates have gone back up. I'm not an economist. I'm not a finance major. I didn't get a Harvard MBA, but this got me tripping. So I started doing some research, talking to some people. I know I got some people, some buddies in the financial markets, but also did some research, and I found an article in Forbes that kind of enlightened me about this. But the first reason is that mortgage rates are up is because bond yields, particularly on a 10-year treasury, have gone up. So the rates of return that you can get in the bond market has gone up. And these returns, these yields directly relate to mortgage rates. While the Fed funds rate indirectly relates to mortgage rates, bond yields directly relate to mortgage rates, right? And so as investors are, kind of putting a lot more money in the bonds and they're getting higher yields, this means that the mortgage rates are going up, even though the Fed's funds have dropped their rates. So that's the first reason. So that's just, bottom line, the bond market correlates to mortgage markets, whether it's commercial or residential. And what's interesting is I do a lot of apartment buildings, and average rates I see right now for my clients are anywhere from 6.5% to 6.75%. Most single family rates are in the low 7%. So it's been probably the last 2 years that I've seen single family rates be higher than apartment rates, which typically is the other way around. So it's a weird time, all right? But that's just what it is right now. Now, the second reason that interest rates are higher is because it's a flight to security. A good buddy of mine who has money in the bond market. And so when I heard about this whole bond thing, because I don't know much about bonds, I called the expert. I called somebody who got their money where their mouth is. And I said, hey man, what's going on with the bonds? Like, talk to me, holla at me. So what he told me is this: yeah, man, investors are going into bonds a lot because they're fleeing to safety. With all the wars going on, Ukraine, Israel, with all the gas price situation, potential tariffs, and even before the election, what's going to happen with the election? Now that we know Trump is going to be the president, some people worried about tariffs. Some people think it's going to be a reduction in regulation, so that should be good for money flow. But bottom line, it's a lot of volatility out there. So investors are fleeing to what they see as safety. And bonds, particularly the 10-year treasury, basically represent safety to investors. So a lot of money is fleeing into that market. And they're also fleeing there because they get a good return, point number one. But it's safety, right? And so this calamity in the world, in the marketplace, is creating even more demand in the bond market because the people want to be safe in perceived times of calamity. Now, what I don't understand is how is bonds going up, stocks going up, Bitcoin is going up, all these things going up at the same price, at the same time. Not real estate prices, right? But everything is going up, right? That's maybe that's another video. I'm not a stock market expert. I'm not a bond expert, but I did call a couple people, read some articles, and this is all kind of starting to make sense, all right? As there's calamity in the world, continued volatility, now there is a flight to these bonds. And the first point was the bond market directly correlates to mortgage markets. And as the bond yields go up, rates are up, even though the Fed funds rates are down. And then the third thing, I got this from the Forbes article I read on this topic, where it talks about a lot of most mortgages are going to be sold in the secondary market. Meaning that mortgage originators, they're going to create the loan, close the deal, get the loan to the borrower, and then they're going to sell the loan in the secondary market. They're going to sell the loan to individual investors. They're going to sell it to big security funds called commercial mortgage-backed securities. And these investors, basically the risk premiums on these deals, the amount of risk that investors are taking have widened. Basically, the investors who invest in this, in the secondary market, they want more return. They want to make more money. And they probably want to make more money saying, hey, I put my money in treasuries, I'm going to make X amount. I put my money in the stock market, I'm going to make X amount. So if I'm going to put my money in this commercial mortgage-backed security or this mortgage-backed security, or if I'm going to buy this individual, a promissory note, whatever, I need to make more money. So in other words, people say, hey, I'm going to take this risk. I need to make more money. All right. How do they make more money? If they're buying into a mortgage-backed security, well, the rates got to go up. So the people who are originating these loans realize that, because before they originate the loan, they know what the people who are buying these want. That's why they originate the loan. So they know, hey, they want to make more money. We're going to have to charge more money. All right. And so these things look, man, I've been in the business 21 years, man. 21 years. I went through the Great Recession. I've been through that. This is a very different time, but it's also a very challenging time. So I had to step back and look and say, all right, well, what's really going on? Let me stop being frustrated and pounding my head against the wall. And let me try to figure out what's really going on so we can figure out how to navigate through this. All right. Now, I got a bonus for y'all as to why these rates are going up. Now, it's a bonus. This is not on the Forbes. This is not on the Wall Street Journal. This is just me, feet to the street. Fourth reason why rates are going up is called greed. It's called, like we say in the hood, get down or lay down. The banks, the mortgage lenders, the people that are making loans are charging you more because they can. And I hate to say that because it's greedy. But look, I know how the lenders roll, man. And a lot of them are greedy. And if they can charge you more and do it and you're going to take it, they will do it. You know what I mean? It's just part of it. That's just, unfortunately, can't live with them, can't live without them type of thing. Now, I didn't get that from the Forbes. This is your boy, Steve P. This is my perspective. And I'm not against lenders because we can't do nothing without them. But I've been in the game for a minute. And if they can stick you, they will stick you. Now, if you got any other comments on this. Now, look, I'm not a bond expert. Not an economist, but this is me trying to put things together for my community, for my clients, for my investors. We trying to make sense of this all. We are fighting the good fight. We pressing forward. We're not going to let the interest rates or, the calamities, tariffs, crazy policies or anything else, whether Republican, Democrat, man, whatever. We're going to keep pressing forward. We're going to figure out how to navigate through this. And, as these interest rates have popped up, we all thought in September, hey, it's back, baby. We're getting back to normal. Hey, look, it's just another obstacle, another challenge that we will work through. And I hope this has been helpful. If you have any perspective, please throw it in the comments. If I was wrong on something, like, Steve, you know what you're talking about with them bonds. Bless me with your knowledge. Put it in the comments, man. Let's get a conversation going so we're just not, running around like a chicken with our head cut off, and we can figure some things out and we can make some deals stick. All right? To the next video, deuces.